Hello again from Core Wealth. I'm Kevin French. I'm going to take you through how we saw February 2023 unfold in financial markets. We'll also have a look at what we expect for the future and how that is expected to influence our clients' portfolios. So February started off well. There was figures coming out on how the manufacturing sector had actually grown compared to the prior month. We then unfortunately had the state of disaster declared by the president in order to try and solve some of the electricity supply problems. In addition to that, Andre de Ruyter, the current CEO of Eskom, had an interview where he basically exposed some of the political corruption that he thought was going on that was affecting Eskom. That caused him to resign with immediate effect. We also had FATF, a global organization that puts controls in place and evaluates companies on how their controls are with regard to avoiding financial corruption. And South Africa did not score as well as it needed to on a few areas. Overall, it actually made some good progress, but in a few areas it didn't score highly enough and therefore was downgraded and added to the grey listing, which affects people. If you're wanting to invest offshore, it just makes the process a lot more cumbersome. Those things, together with seeing interest rates rising in the US, saw the South African rand weaken during the month, particularly against the dollar, and also saw the JSE come down a little bit, which we'll talk about a little bit later on. So the UK was in the news, and during the month of February, the results came out for the last quarter of 2022, and the UK has managed to avoid a technical recession, in other words, 2 quarters of negative growth, but the economy is still smaller than what it was prior to the COVID crisis, one of the few countries around the world for that to be the case. In the US and China there's a whole lot of political noise that I'm sure you've read about, and that caused the US stock market to come off during the month, having had a very strong start in January. Looking further afield, we saw Purchasing Managers Index coming out again, measuring manufacturing, and we've seen manufacturing growth continue to improve in both Europe and the UK and the US. And the big concern, though, remains around the world: is inflation under control yet, particularly in the US? And signs at the moment are that interest rates are going to have to go up further in the US, and that is a bit of a handbrake on global stock markets. So if we have a look at how markets did for the month of February, this table shows us that there are a few patches of green, but those are generally because those are offshore assets, and we're showing returns in rands here, and the rand weakened by just over 5% to the dollar during the month of February. So if you adjust for that, actually all the equity and bond and property markets, both locally and globally, were down for the month. This was on the back of January having been a really strong month, and some of that pullback was to be expected, but then some of the reasons I mentioned previously saw markets come back a little bit further. If we look over the last year, we can see the best place to have been for a South African investor was global equity markets. So not a fantastic year, but to be expected given that 2022, most of it was a really tough year on the back of the global turmoil around the war and the oil crisis in 2022. So if we have a look now at more of the longer term performance of the different markets, we can see that if you look at the 3-year number now, for South African equity investor, you were getting almost 20% over the last 3 years. As a global equity investor, almost 16%. With inflation at around just over 5%, those are really strong returns over the 3 years. So we're again starting to see things a little bit more normal in terms of long-term returns from equity. And that's really where, if you're wanting to grow your wealth over the longer term, one does have to have a bias towards equities. So let's have a look at how these market conditions translated to returns for our clients. And you can see here over the month of February, everything was positive, which for us was quite good given that there was very little place to hide other than in cash to protect against a negative return. The other thing that's particularly pleasing is that all of our portfolios over all of these time periods have outperformed their peers. So there's lots of green on this slide. And then lastly, nice to see over the last year now, despite all the challenges, 4 of the portfolios have actually delivered double-digit returns in some challenging markets. So very happy with what we're seeing on our local portfolios at the moment. Right, let's have a look at the same thing, but just for our international or global portfolios. And this table shows you the US dollar returns. The big difference here is that the shorter term returns are all negative, even though most of them have outperformed their peers, hence the green shading. But over the longer term, we can see some decent return in hard currency. And bear in mind, this is a 6-year track record, and so will include the COVID crisis as well as the pullback that we saw last year. So quite happy about the performance that we're receiving in our dollar strategies. Now this slide just shows our global strategies, but for sterling or UK pound investors. And one can see here that again, some good outperformance over nearly all of the periods. The month of February was negative because global markets were down, and the since inception returns are also negative, even though we've outperformed peers quite nicely, because these strategies only started just over a year ago, and that period has been negative for global markets in sterling terms. So a yield is an indication of whether something's cheap or expensive. The higher the yield, the less expensive it is. This graph here shows us a few things. The purple lines are the current yields on these different asset classes that you can see at the bottom of the graph. The gray line is what that yield was in August 2020. What you can see is that in August 2020, yields were a lot lower than they are now, and they've risen dramatically, especially on the fixed income side. So most of the lines on the right-hand side of this graph. The other important thing is that some of these fixed interest yields are now higher than the yields you'd earn on listed property or on equities. And that has an interesting consequence looking ahead. So this next graph just has a look at the yield on US equity, the S&P 500, comparing that to a 6-month treasury yield. It's virtually like putting money in the bank. And what you can see is the green line now is at the same level as the yield on US equities, the dark blue or black line. You're getting the same kind of return from a low risk asset as you are getting from a high risk asset. And you can see this goes back to 2004. You've never seen that before. This implies that treasury assets are cheap and equities are way more expensive. So if we have a look at what could happen, either equity markets have to fall for their yields to go up, or interest rates have to come off dramatically for their yields to go down. At the moment, because of inflation being too high, interest rates are not expected to come down in the short term, and therefore what could happen to equity markets. And this next slide just shows you a picture of the 2-year treasury yield and the price earnings ratio of the S&P 500. You can see that historically they move in line. At the moment, the difference for them to get back into line could mean that we could see equities in the US drop by as much as 10%. Some people have been suggesting more, but on this level of research, we're saying there's a possibility for equities in the US to pull back by about 10%. And this is why we've been underweight US equities at the moment, just while there's this uncertainty until we see interest rates turning. Last comment on the US equity markets is around the equity risk premium. Risk premium simply says I want to have a high risk premium, so I'm rewarded for the risk I take by investing in equities. And this graph just shows that plotted through time. It goes back to the late 1990s, and essentially to get a good risk premium, as you'd expect, the graph needs to be higher. At the moment, however, that orange line shows that if we're below that, we're basically in the lowest quarter of returns that or risk premium that we could have. And that's where we are at the moment. The only time it's been worse than this was mostly during the dot-com bubble in the late 90s, early 2000s. So there is some risk, especially in the US equity market, we think in the short term, but longer term, our portfolios are well diversified. We've managed in the past to generate good outperformance for our clients, and that strategy continues. We do see some interesting green shoots around the world, particularly in Europe, to some degree in the UK, but then also in Japan and emerging markets. And it's about being diversified across these to get returns whenever a different market fires. So if you have questions, please give us a call. We can't afford for our clients not to be invested, because over the longer term, even if there's a war or if there's turmoil or what have you, you want to be invested to ensure that you get the growth over the longer term. So give us a call. Other than that, we look forward to seeing you again during the year.